I published a new blog post earlier today, April 26, 2026, discussing some of my trades over the past few days. A link to my blog post can be found in the profile section here at YouTube. I am continuing to reduce my already low stock allocation by selling into the ongoing stock market rally. New highs were hit last week, even though the University of Michigan reported that consumer sentiment hit an all-time low. That is, since it started to collect that data. Job losses due to AI are just starting to accelerate, and that is in its early stages. The Strait of Hormuz remains closed, and the probability that the strait will reopen soon is nonetheless being priced at 100% probability, in my opinion. That is not a rational assignment. Maybe the Iran war will end soon with the strait reopened for safe passage, but the odds are nowhere near 100%. Inflation remains well above the Fed's target, and the U.S. job market remains weak. My inflation rate, based on what I actually have to spend money on, is far higher than the government CPI. One of the largest weightings for me is an insurance cost that include home, car, umbrella, and health insurance through Medicare and my Blue Cross supplemental. Insurance costs for my home, cars, and umbrella policies almost doubled in the 2-year period ending in July 2024 and have continued to increase at a far faster rate than CPI, even though I've had no claims. That's just one example. I noted that the appliance maker Electrolux reported a first quarter loss yesterday, resulting from weak U.S. demand. The stock sank over 25% yesterday, and that's just the kind of reaction that a stock can have when a disappointment occurs of that magnitude. I am now extremely uncomfortable with the U.S. stock market, where valuations are near all-time highs using traditional measures like the Shiller PE and the U.S. stock market capitalization, the GDP, sometimes referred to as a Buffett indicator. The Buffett indicator is well above its previous all-time high. The indicator closed last Friday at 228% compared to about 148% in early 2000. So that indicator is well above where it was when the market corrected over 50% starting in 2000. The Shiller PE is at almost 41 now, near its previous all-time high in 2000, and those are two examples of what I call traditional valuation indicators. And all of those indicators are occurring even though there are major and obvious negative factors that would ordinarily cause more caution. Those factors include the Iran war and the closure of the Strait of Hormuz, rising inflation, weakening consumer sentiment, a weak U.S. job market that will be restrained in the decades to come by AI, the chaos created by Trump's U.S. tariffs on the supply chains and the cost of goods to U.S. consumers. My assessment is that the U.S. is not yet in a recession, but is teetering on the edge of one. But you would not know that, if that is the correct assessment, by the current stock market index levels. An important issue for me is my opinion that the current U.S. president is suffering from a variety of serious mental illnesses and is likely to continue to make impulsive decisions without any analysis of the possible repercussions, short or long term, and without the input of any accurate information. When making decisions on my investment allocations, I start with my investment objectives, with the two most important being, as I've said many times here and in my blog, preservation of capital and income generation. And that is achieved through a very widespread variety of owned securities. Three factors that significantly influence my investment allocation decisions are my age, current financial condition as mitigating the need for any risk taking, and the fact that I am retired. Taking into account those factors, I then assess the risk-reward balance for each asset category in light of those objectives. To evaluate risk, I need to acquire as much accurate information as I can, and then assign my own probabilities to various possible future scenarios using my own judgment and experience over the past several decades with the markets. The assessment may end up being wrong, and of course I know that going into making them, but I still have to make my own assessments. The assessments have led me to increase my allocation currently to Treasury bills and short-term investment-grade corporate bonds. I'm not happy with the yields on those investments, but they are satisfactory for me on an after-tax basis to meet my current living expenses. So I am fortunate in that respect that I don't really need to increase my capital through capital appreciation through risk investments.